So there's a Kilelesha apartment in Isaac, Aki, I enjoy, all own it, I don't complete strangers. But there's these models that these companies are coming up with where I can earn rental income. I'm young, I don't have that much money, so I can't put 7 mil down, but I can put 500K down, or I can put, and then I'll still own. So it's in Kile, it's in Kilimani, and I know it'll get somebody, or it's in Jammu or Syokimau, I know it'll get somebody, but I can't own the whole thing by myself. So what do you propose about such things? Are there rules and regulations about how to go about that? Yeah.
I mean, I have mixed feelings on this. So the big issue with rates, particularly in Kenya, in the region, is we've only had one, and it didn't go so well. So there were, but it was mostly from unique circumstances specific to implementation of that rate. So REITs in themselves, they're actually pretty good innovative products where firms can easily raise capital to build massive real estate projects, while at the same time having several people invest in them. Yeah. So as an investment product, it's a fantastic product. The only issue is whether we're going to have enough of REITs coming up in this market. The regulations only came up about 2-3 years ago. As I said, we've only had one, it hasn't done that well. A lot of people are shying away from listing REITs following what's happened with the Greenspan Mall one. So I think as a product itself, it's fantastic. It's just whether we're going to have the uptake going forward. And then the other issue would be now project REIT-specific issues. So going forward, are we going to have people coming up with really lucrative real estate investments under the various REITs that are going to come up? A big advantage of REITs is, I don't know whether you're aware, but tax advantages. I think you're taxed at 10% all in, as compared to 30% for all other investments. I think it's only Kenyan investment which has a slightly lower tax rate. So hopefully going forward we'll have other players bringing in such products, but yeah, until then there's not much there's not much to invest in.
Can I just follow up? What if the four of us decide to buy an apartment together?
Oh, so something more informal, such as like the four of us buy an apartment together.
The same reaction across. Let's read.
So, this actually happened to me. The thing you need to look out for is whether you're all committed, because some of you might drop out in the middle of paying for the house. What does that mean? If you owe 7 million, let's even use simple math. You owe 4 million, you're 4 people, halfway through paying 300,000, one of you goes like, I can't anymore. Who pays the 700,000? Those type of questions. It's very, very tricky. The other thing is, it's very hard to agree on a property as a group. But if you can find the people, I think it's the best way to go.
But just to add to that, the thing with real estate is it's such a long-term commitment that the group that you decide to do this with has to be committed for 10 years or more. And that is a difficult thing to know about someone now. It's very, very difficult, which is why most people buy real estate with their husband or wife, or mother and father. So that's something to consider. I'm not saying don't do it, just really vet the people that you do it with. Because if someone needs to pull out the cash in 5 years and then you're forced to sell, and it can be messy.
So this is obviously like a topic that's sensitive. The broad answer is watch who you mix your money with and how you mix it, right? It's very, like Lauren just said, when you're all legally liable for a thing that you're only quarter way through paying, and some guy's like, okay, I'm done. You get in trouble that you didn't need to get in trouble for, right? And the second thing is, going back to, the thing, it's a really simple rule, but what are you buying? And is it a fair price? So one challenge with complex investments, we've created a way for you to buy things together. you also need to pause and ask, is that thing priced well? Right? Like we could have found I can decide I'm gonna build a block of units. I wish I had the money, but I had a block of units that I'm gonna build, and I'm gonna target it to people who are about X years old and tell them you can't afford it yourself. I have structured a way for you to buy it as a group. Then I increase the price of that thing. So I know it's worth 7 million, but I charge you 10 million for the house. Right? So there's always like, is this thing priced well? Is it the asset that I want? And when you know what it is you're buying and you know it's priced well, know why you're buying it. Right? So for example, if you're buying a house because you think you want rental income, maybe what you actually want is predictable cash flows. There are other ways you can get predictable cash flows. So if you only have X amount of money and you want predictable cash flows, then ask what other assets in the market can give me these predictable cash flows that I want, because the answer is not necessarily the thing that's right here. And taking a step back and seeing what other assets are out there that achieve the thing that I want, which could be I want predictable cash flows, then you can do that without having to make it super complex. Right?